Welcome to another episode of Spy Trader, your go-to podcast for all things S&P 500. I'm your host, Jimmy Bulls and Bears Rickshaw, and today is August 23rd, 2024 at 18. Let's dive right into today's financial roller coaster. Key news items. The S&P 500 is up 18% year-to-date, driven by investor optimism about artificial intelligence, AI. But Vanguard warns this could be overly optimistic. To live up to the current stock valuations, U.S. corporate profits need to grow by 40% annually over the next 3 years. Historically, we're looking at a 10.9% trailing earnings growth rate as of Q2 2024. Vanguard's Joe Davis says this expected growth rate is double that of the roaring 1920s, an era of huge technological advancements. Vanguard projects a slowing economy with GDP growth of just 1% to 1.5% in 2025, making such profit growth unlikely. Despite skepticism in the short term, AI is believed to have long-term potential, promising a 3.1% annualized growth rate from 2028 to 2040. Investment required for AI to hit a $1 trillion scale by 2025 is astronomical, a 286% growth in investments, which Vanguard deems unrealistic. BlackRock analysts caution that the rush to AI might bring higher inflation rates, complicating corporate profit growth and economic recovery. Analysis and insights. All right, folks, let's unpack this. The S&P 500 has had a fantastic run this year, largely due to the hype around AI. But let's not get carried away. Vanguard is basically the party pooper here, pointing out that we'd need gargantuan profit growth to justify current stock prices. Imagine asking Usain Bolt to sprint at double his peak speed. Impossible, right? Remember the 1920s when electricity was the game changer? The growth rate we're aiming for today is double that period. That's kind of like asking for 2 lightning strikes in the same place. While AI holds dazzling long-term prospects, getting to that future involves a ginormous leap in capital investment, a leap that might just be a bit too high for now. Why did the bank organize a party? To celebrate its interest. Trading recommendations and reasoning. It's time to get strategic. Given Vanguard's warning about overvaluations and slower economic growth, here are 3 recommendations. Shift towards value stocks. Companies with stable earnings are your friends in uncertain times. Think of sectors like utilities and consumer staples. These won't give you the same adrenaline rush as AI stocks, but can provide steady returns. Diversify. Don't put all your eggs in the AI basket. Try a mix of growth and value stocks and consider assets less directly affected by economic downturns, like commodities. Stay liquid. Keep a portion of your portfolio in cash or cash equivalents. This way, you're ready to pounce on opportunities when the market corrects itself. Lastly, keep your ears open and eyes peeled on the macroeconomic indicators. If we start seeing deviations in corporate profit growth or GDP figures, it might be time to reassess our strategies. Inflation could creep back into the picture, especially with heavy investments into AI, so be nimble. That wraps up today's episode. Remember, navigating the stock market isn't about riding the waves of hype, but about making informed decisions grounded in reality. Until next time, I'm Jimmy Bulls and Bears. Rickshaw reminding you to trade wisely and stay invested in your future. Catch you in a few hours for the next update.